For investors looking to hedge risks, capitalize on market swings, or supercharge their portfolio performance, the derivative market is a familiar powerhouse. For those who aren't, in this episode of How to Invest by Julius Baer, we look at how you can invest in an instrument that derives its worth not from the asset itself, but from options tied to that asset. Sounds complex, and it can be. So buckle up for a lesson in one of the most important and exciting markets in the global financial system. The derivatives market isn't a physical place, but a web of options connected to financial markets, from stocks to bonds, commodities to currencies, and much more. These versatile tools offer opportunities for risk management, speculation, and profit enhancement, but wielding them successfully requires a solid understanding. So let's break it down. The primary purpose of derivatives is to manage risk, speculate on price movements, or gain leverage. They let you lock in options on investments like stocks, bonds, commodities, currencies, interest rates, and market indices. As a buyer of such instruments, you have the right, but not the obligation, to act under specific conditions. Think of it like insurance. You pay a premium for some protection, but instead of dealing with an insurer, you're engaging with the bank. Of course, if you're selling the derivative, then you receive the premium up front, but you are now exposed to the risk like an insurer. Common types of derivatives include futures and forwards contracts, which are agreements to buy or sell an asset at a predetermined price at a specific date. Swaps are agreements to exchange cash flows based on different financial instruments or rates. And options are contracts that give the buyer the right to buy or sell an asset at a predetermined price within a specific time frame. This includes put options, the right to buy, and call options, the right to sell. Sounds great. But before you dive in, there is one key question to ask yourself before looking at derivatives. Why are you using them? Participants in the derivatives market use it for four main things. Hedging, to protect against price movements in assets. This uses tools like derivatives to minimize risk or protect against future uncertainties. For example, a wheat farmer might sell futures contracts to lock in a price before harvest, safeguarding against a price drop. Because the value of the derivative tracks the performance of the underlying asset, it can make them a more precise tool for managing the risk. Other investors might use derivatives for speculation to profit from anticipated changes in the price of an underlying asset. Unlike hedgers who use derivatives to minimize risk, speculators take calculated risks by trading assets in pursuit of short-term gains. For instance, a speculator might buy a call option on a stock, hoping to profit from a price surge. If the stock rises, they can sell the option for a gain without having to buy shares directly. But this strategy is high risk, as of course markets can move against you just as quickly as they can for you. Arbitrage and margin traders go one step further. Margin traders use borrowed funds to amplify trades, aiming for bigger profits, while arbitrage traders exploit price differences across markets to secure profits. Often these investors are institutional in nature and can better manage risk because of their size. How can derivatives help you? Well, let's just look at a couple of examples. Let's say you're going on holiday to Australia in 9 months' time, and you know that you will need to buy Australian dollars before you go. Well, here you can use options to buy those dollars only when they hit a certain price, allowing you to potentially buy more Aussie dollars for your Swiss franc, ensuring that you have some extra spending money on holiday. If you'd like more information on other ways you can invest in currency markets, we have a whole episode on the opportunities there. Just check out our previous episodes. Now, you can also enhance your yield on a stock by selling a call option. Here, you can sell the stock if it reaches a certain price. Now, if that stock doesn't reach this price, then you keep the premium, which is the price of the call option, while retaining the stock. But if the stock climbs above the specified price, you will have to sell the stock as the buyer will exercise the call, although you did at least receive a premium initially. Conversely, An investor can sell a put option, allowing them to buy the stock only when it reaches a certain price. If the stock stays above this price, the option expires and the investor keeps the premium. Confused much? Well, you're not alone. Derivatives are complex, but invaluable tools. Their liquidity and accessibility make them attractive, but they require clear goals and a firm grip of how they work, whether it's for managing that risk, trying to enhance those yields, or even speculating. Check out our other episodes on how to invest by liking and subscribing to the Julius Baer YouTube channel.